Good afternoon, everyone. I'm Lucia Labella and I'm the Customer Executive for Commercial Real Estate. Thanks for joining us on the webinar today. Tuning in, we've got over 500 customers from all over Australia, so we've had a really good turnout for this session, so thank you so much for taking the time to be here today. We know it's truly extraordinary days that we're living through at the moment. Like, who would have thought 2 weeks ago that we would be in this situation? But we really appreciate that you're taking the time to be better informed and to also to understand the support that NAB can provide you. As the impacts of the coronavirus continue to unfold, we recognise that this is a really challenging time for you, our customers, and our broader community. Many of our SME owners are facing difficult decisions and are seeking guidance, support, and reassurance in making those decisions. Specifically in property, it's been particularly challenging given the government has stepped in and mandated support that landlords need to provide for tenants through the Commercial Code. Customers are reaching out for information, and just to kind of give you a little bit of an idea, we've had the same amount of calls in a week that we would normally receive in a typical year. Many of you as landlords are suffering reduction or loss of income, and that's having an impact on your profitability. And as developers, you're probably wondering, what does it mean for your projects that are underway, and will your purchasers be able to settle come time when they need to? NAB is here, and we really are trying to make it easy to support you. And we want you to understand not only what's available to you, but also what can your tenants and your property purchasers get support from NAB from. So to that end, we've got a few key topics we'd love to cover. We're going to kick off with Alan, and he's going to share with us views on the economy and talk about the macroeconomic situation and how banks and government stimulus is playing out to support the economy. And he'll also give us a bit of a view in terms of what an early recovery might look like. In addition to that, we'll then kick over to Kane Perry, and he's a strategic dealer in our markets area. And he's going to take us through the recent interest rate changes in the market and then what conversations we're having with customers as a result of this. We'll then wrap up with Rebecca Licciardi. She's our Customer Executive for Small Business, and she'll step us through the NAB support packages that we have for customers. So I'll just kick over to a bit of housekeeping first off. So this session will be run for 60 minutes. It's a webinar and it will be recorded, so it will be available to you to review post. We will email it out to you, and it also will be available on our website. We will also provide you the presentation pack, and that obviously has links in it with live information that you're able to look at further when you need to. We are also going to have a Q&A session as part of this, and we've allocated around 20 minutes for that at the end. So please use the Q&A function with the Zoom that you can see on your screen there. We would love to know what's on your mind and be able to clarify any points that you have. There has been quite a few questions submitted previously, and we have got a few themes that have come out, so we will cover those as part of the Q&A. But if you have anything else, please feel free to add it on. And if you want to be identified, please add your name to that as well. So let's kick on. Alan, I'd love to start with you. You're our esteemed Chief Economist, so please, let's hear from you. Thanks, Alan.
Okay, thanks, Lucia. Look, I've only got 10 minutes to cover all this, so I'm going to be very big picture. Basically, the world is facing unprecedented slowdown in terms of growth. The timing of which economies get hit really depends on when they closed them down. So you've seen China, their first quarter GDP numbers were down essentially, well, 9.8%, let's call it 10% in the quarter, which means they're not going to grow much at all this year. In the big economies in the developed world, like Europe, UK, Japan, and the US, that's really the second quarter hit, and generally they're talking about a 10% decline. So overall, the developed economies of the world are looking at 6, maybe 7% fall in GDP this year. A lot depends on the timing of when the virus containment starts to be eased. But a context, the previous worst global recession outside of the Great Depression was the GFC, where global growth was 0. We're expecting global growth to be 2.8% negative. So this is going to be as bad as anyone alive today has seen. So that's the context. It's very much a V-shaped in terms of the economy. Let's talk a little bit about Australia. In terms of Australia, what we've seen is really this big slowdown starting from the back end of March. So it's only 3 to 4 weeks old. And so very difficult to basically get good, reliable numbers. I'll give you an illustration. In our survey that we took for essentially the March quarter, so basically say mid-Feb to mid-March, basically nothing changed in terms of business conditions and confidence and forward orders. Then we took a survey at the back end of March, and confidence went from -4 to -66, which was 3 times worse than anything you saw at the bottom of the 1990 recession. If you look at forward orders, if you look at capacity utilization, you also got massive hits and worse readings within a month than what you got at the bottom of the 1990 recession. Business conditions, which is sort of employment, profits, trading, that was basically coming down big time, but not quite there yet, but it will get there. What you've also, and so, you know, we're all sort of guessing how long will it last. Our sort of assumption is that it will probably start to ease up in a fundamental way by about September. So our guess would be that the March quarter probably is a small negative. The June quarter, we've got -7. And I think the Reserve Bank and the government's out talking could be as high as -10. Then we've got it, September quarter, something like -1. So we're talking about a peak to trough in the next couple of quarters of about 8.5%. Then we have a recovery, once you start to turn back on, of something like 8%. So in year average terms, rather than just the V, you get something like -4 and something like +4 next year. Now, different parts of the economy have been hit very differently. So you will see, for example, and there's a good illustration of it today when you had retail sales, it was dominated by supermarkets. And so supermarkets are up 40%. And so retail sales in the March month went up 8%, the all-time record. Now, we know internally when we look at some of the data that that's already stopped. And what we know is when you look outside of retail and the hoardings areas, what you see is basically massive falls in some sectors. And we are basically internally trying to track this data, both in terms of what people are spending and what businesses are getting in terms of revenue each week. So by Tuesday, I know what's happened across all the bank's systems by industry and by essentially consumers as of Sunday. So we're within about 2 days. And what we're seeing is very different impacts as well, as you'd expect. So accommodation, clubs and pubs, recreational services, transport, think airlines, all those things are being absolutely hammered. On the other hand, agri is doing a bit better, and up until early April, supermarkets were doing really well. But they're all now struggling a bit as we talk about it. And so we're fairly comfortable that we're going to see a huge amount of damage in terms of the economy. When we say it's a V-shaped recovery, you need to be slightly careful. And that is, unlike previous recessions where people hoarded labour initially and then fired them essentially 2 years later. So the peak in the unemployment rate in the 1990 recession that started middle of the year was not until December 1992, and that got to 11.2%. We suspect in the next couple of months, unemployment will be up somewhere around 11.75%. The government is being a little bit more conservative. They're saying up to 10%. I can't honestly tell you the difference between 10 and 12, but I can say it's a big hit. What the government's packages have been trying to do is to keep people employed. We're already seeing in our internal data, and the ABS is also running some data about payrolls, massive hits to employment between the end of March and the middle of April. If I'm looking at some of our internal data now, I'd probably say in a month's time, when you get the April reading for unemployment, it's probably going to be somewhere around about 9% unemployed already. Now, what the JobKeeper package tries to do is to avoid people getting unemployed to levels like 15 to 20%. And 20% was generally what people thought happened in the Great Depression. Some sectors will be fundamentally affected in a permanent way. So I worry, and we're talking about commercial real estate today, I worry that while everybody's doing Zooms and working from home and all that sort of thing, the amount of demand for commercial, and particularly for office, is not going to be anywhere near as big as what it has been in the past. And so I think there is an issue there in terms of commercial property that I don't see going away anytime soon. Industrial, you might get a little bit better because they're still doing a lot of takeaway food and storage and all that sort of stuff. Retail, I think, has been clobbered and it will take time. Lots depends on the phasing of when you release things. I think you will probably, there's talk about some of the health stuff, volunteer, or basically in some of the operations being loosened up fairly early. I think things like clubs and pubs are going to take longer. Domestic travel, I think, will probably be opened up reasonably early. International travel, I don't see opening up at all. One last thing, because I've really done my time, is that whilst I've talked a lot about a V, it's really important to understand that if you drop by 8% and then from that lower level increase by 8%, you're actually below where you started. And when we look at our growth forecasts, whilst we talk about a big V in growth, the level of GDP that we had at the end of 2019 won't be achieved again until about early to mid 2022. So that means that the level of unemployment is going to stay really high for a really long time. So we're at 11 3/4. By the end of next year, we're hoping we'll have an unemployment with a 7 in front of it. Reserve Bank's talking about a couple of years of 6%, but they're coming from 10. So this is a really serious recession. It's got a V shape in it, but it is going to change some things permanently. And to me, commercial real estate is going to be an issue. The other issue that we're worried about is house prices. I could easily see 15% fall in house prices over the next 12 months. Normally when unemployment gets to 8%, that's a problem. And temporarily what we're hoping is all the banks are going to look at customers and say, if you're good before the virus, you're good after the virus. And so therefore they won't be foreclosing. But it's a very challenging time. Damage has been done and it'll take quite a while to sort of recover. So they're my sort of opening 10 minutes worth. Lucia, I'll hand back to you.
Thanks, Alan. Appreciate that, even though there's definitely some sobering news there that we all need to kind of take on board. There'll obviously be more questions for you down the track, so thank you, Alan. Kane, I'd love to move to you. Obviously, you're an expert in interest rates and the market and what's happening there, and love to hear how we're supporting customers during this time with your team. So Kane, over to you.
All right, thanks, Lucia. So my name's Kane Perry. I work in markets in Victoria here, predominantly looking after commercial real estate clients. So my role is generally talking about clients' longer term horizons in terms of how their business operates. But I guess as COVID-19 has come about, we're increasingly talking about the immediate term and the immediate future of a lot of businesses. So, and also the associated cash flows that goes with that. So with a bit of luck, there's a bit of light at the end of the tunnel, as sort of Alan was sort of alluding to, but the uncertainty is still very high from most clients. Governments and central banks have taken unprecedented policies to try and counteract some of the negative impact on the economy. And so from that, on a local level though, many of you have been running through different scenarios whilst talking to me about, what if this client doesn't pay rent, how do we cut costs from the business, and working and reworking cash flows is becoming commonplace. And a large majority of people who have been affected have reached out to NAB as to how we can help. And I guess Rebecca will speak more at the end about other ways that NAB's helping clients, but from my area specifically, for those who qualify for COVID-19 assistance, the option is there to defer interest on business loans for up to 6 months, and that's available for people who qualify for that. Even those who have fixed rates, corporate markets loan, business markets loans, and interest rate swaps. Generally, there's a cost to do that. The NAB's covering that cost in these circumstances, deferred for 6 months to try and help clients for that period of time. So, you know, in certain circumstances with some clients, they're saying, well, 6 months is great, but what else can we do to smooth over cash flows beyond that time? And so in certain circumstances, we're providing longer term relief to smooth out interest costs and provide large interest savings when it is required from a timing point of view. So the key point here is that, you know, your markets representative can look at your revised cash flows and match the interest expense that you've got. So fixed rates don't have to be linear throughout the whole fixed term. So in some cases where the rental has been deferred and is looking to be paid back over successive years, interest rates can be structured similarly to have lower rates at the front period of time and have a lot higher at the back to match what those cash flows are and the match rental receipts that you're expecting to return. So likewise, it's not a game of everything needs to be all in one bucket. We can certainly look at percentages as well. So if rental incomes decrease by 60% over time, we can certainly look at matching interest costs of that. And so, you know, COVID-19 has impacted each business differently, and also everyone's circumstances will be very different as well. So whilst, you know, NAB's got the publicised interest relief measures that they've got, I encourage you to talk to your local markets dealer and also banker, as there are more opportunities there to tailor solutions to your specific needs. So I guess as moving on and as we move towards some lightening of restrictions, clients' eyes will naturally shift towards the horizon and plan out their business of what may look a different environment as to where we are. And so from an interest rate perspective, the RBA and government's COVID relief policies have probably structurally changed what we see from interest rates and the way they function in the short term. So to best summarise this is to talk about what we know as the yield curve, so or the pricing of interest rates with different maturities. So the chart on the screen at the moment is the Australian government bond yield curve, or in simple terms, the price that the government pays for borrowing at different terms along the cycle. And that can be split into two parts. And it's probably the easiest way to look at it at the moment is the short end, so rates out to 2 to 3 years, and the long end, which is interest rates beyond the 2 to 3 year mark. So, and movements in these yields directly affect business borrowing rates, which is probably why it's important for CRE clients. So the blue line on that chart is where the yield curve was back in January 2020. So but pre-COVID-19. The red line is where the government yield curve is pricing yesterday. And I guess so to highlight what's happening in interest rates, government yield curve is 0.75 in for the 3 year money back in January. Yesterday it was 0.25%. So it's dropped 0.5% over that time. And so with the RBA's policy of cutting the cash rate to 0.25 and keeping the government bond as close to 0.25% by buying government bonds, what we can see from this chart is the majority of movements we've seen in interest rates has been at the front end of the curve. So periods out to 2 years, 2 to 3 years from that respect. And further to that is that we see a fair bit of liquidity in the short end of that, which is probably pushing down shorter term rates such as BBSY in the immediate term. So further out, which is what we tend to talk to clients to, which is called the long end of the curve. Whilst interest rates have pushed to record low levels from the government's point of view, they have not seen the dramatic falls that we've experienced in the short term maturities, even though there's been some intervention in those type of markets. So, and this is a result of the RBA's policies, which have effectively anchored the front end of the rates out to 2 to 3 years, meaning that as data changes, as sentiment changes, the only part of the curve that can change is the longer end. And so in normal market conditions, interest rates would move with sentiment. So any recovery would be priced into higher interest rates before they actually occur in the front end, the shorter end of the interest rates. So if we see improved sentiment over time, what we'll see is interest rates move, but only in the long end of rates. So it's likely to be volatile for the immediate period. So if we see sentiment, global sentiment deteriorate, longer term rates will likely fall. If we see positive sentiment or a glimpse of recovery, longer term rates will likely rise. And so this is akin to a dog effectively wagging his tail as we see the front end anchored and the back end swing around. So why is this important for commercial real estate clients? So as we lift our eyes out of the beyond on the horizon and beyond the COVID-19 challenges, those with long lease terms will generally still have likely longer term interest expenses they need to meet. And so this is why the longer part of the curve is important for clients, by matching off the pricing of the debt to its expected term. And so by taking that expected price in the longer term, you can secure a known return from your investment. So, but when looking at the returns and the pricing signal in the market at the moment is that, you know, short-term pricing signals, the market is pricing it so from a market flush with short-term liquidity and subject to intervention, and can distort what the pricing we get, particularly in the BBSY market. So moving on, and as we've seen from Singapore, recovery from COVID-19 may be not straightforward, which means the global sentiment can change very, very quickly. And this means that longer term rates can change very, very quickly as well. So it goes to the aforementioned volatility that we're seeing. So there'll be opportunities for clients looking into longer term, particularly as things start to look a bit rosier. But the main thing is you need to talk to your local banker and local dealer to make sure you have a strategy in place and things are in place to act ahead of time. So I encourage you, if you need a further interest rate risk management conversation or put measures in place to take advantage of any opportunities that we're seeing, I encourage you, again, to reach out to your local markets dealer and reach out to your banker, and they'll be more than happy to discuss further. Lucia?
Thanks, Kane. That's really informative and great information for our customers to start to have a conversation and think about that. We'll now shift gear and move across to Rebecca. So Rebecca's going to take us through what support we have available for NAB and take us through our support packages. So thanks, Rebecca.
Thanks so much, Lucia, and thank you everyone for joining us for the session this afternoon. As Lucia mentioned, NAB has been working considerably long and really hard to ensure that we could set up a package that is as responsive for our customers' needs in the moment and take away some of the uncertainty and anxiousness we know that they're feeling right now, particularly when it comes through to working capital and cash flow requirements. So the package is really centred around how we can assist customers who currently borrow from us and alleviate some of the concerns and pressures they're feeling in relation to existing borrowings. And that refers to the deferral of principal and interest for up to 6 months. That includes fixed, floating and variable rate loans across the majority of our business products, including also equipment finance, and it includes both interest only and P&I facilities. I think it's fair to say that when we embarked on this approximately 4 weeks ago, we were very much responding to the needs of our customers in the moment, and these offerings have evolved considerably as time has progressed and will continue to do so as we respond to the needs of our customers. We are also providing our merchant fee waivers on rental for up to 3 months. We are providing opportunities for customers to pause credit card repayments for up to 6 months. And we're obviously not excluding our home loan customers, offering them also 6 months deferral on terms for both P&I and interest only for both owner occupied and also for investor loans. So this has been a really critical part of our initial support package, recognising the level of uncertainty that currently exists in the broader market, which both Alan and Kane have spoke to so eloquently this afternoon, and ensuring that we are being very responsive and consultative with our customers, given their particular circumstances. In addition, we recognise that being able to assist with existing borrowings and being able to place a pause on existing commitments may not be enough, and therefore have worked with the government as part of the Coronavirus SME Guarantee Scheme to provide what we've referred to as our NAB Business Support Loan. So this support loan is exactly that. It's designed to support customers with working capital and cash flow requirements for up to $250,000. It's on an unsecured basis, so we're not requesting any additional security or cross-collateralisation of any existing facilities that customers have with us. We're offering a variable interest rate on that of 4.5% with loan terms of up to 3 years. So it's really important to note that in similar keeping with our deferral scheme, we're also deferring the requirement to meet interest and capital, or interest and principal, I should say, repayments for the first 6 months, recognising this will be capitalised to the loan, and it is required to be fully amortised over that remaining 2.5-year period. So that would be through P&I instalments over that time. And of course, no application or loan service fees are applying to the new facility. It does impact customers who have a turnover of less of 50 million. So it's very much centred on customers who are turning over less than 50 million. It is for new applications only, so we cannot apply this to existing facilities with NAB. It's a separate facility, and it must be for business purposes only and being used to support, as I mentioned a couple of times already, current and upcoming working capital needs. I think what has been a really common theme, and I might address this proactively within my initial quick time slot here, is lots of questions around, well, what happens in 6 months' time? Alan has spoken to, what is not a rosy picture on any front. So do we necessarily have an expectation that our customers are going to be any better placed to start meeting interest and principal repayments in 6 months than what they are today? And so the answer to that is no one can speak to that with any level of certainty, and it requires us to work really consultatively with our customers to ensure that we're meeting their specific needs. So in the very first instance, if we do have customers who are able to generate cash flow sufficient to start meeting their commitments and have a real desire to do so, then we have the option for those customers to extend the loan term, so that they can absorb that additional amount over the initial term, therefore not impacting what would have been that pre-COVID requirement or commitment. Alternatively, we may need to sit down and consider other options for those customers who are not in a position to start meeting principal and interest repayments. And we understand that at this point in time, we don't have a significant level of visibility of exactly what that will look like, i.e. the number of customers who will be impacted for a much longer term. Understanding that for different businesses, this has impacted them differently. And for a lot of our customers, they have definitely demonstrated a desire not to have to capitalise interest in the short term, preferring to draw on their own cash reserves or ensure that they minimise, therefore, that additional interest expense over a longer term. So this is about how we continue to work with customers, recognising their individual requirements and recognising that that will be really a moving dice as we continue to respond to each happenstance as we encounter it. I think it's fair to say what was really appropriate 4 weeks ago rapidly changed within 2 weeks, and then rapidly changed again a mere 10 days later. What we had put to market has stayed reasonably consistent, but we've evolved considerably the offerings. So as I mentioned before, extending from both floating and variable rates now to fixed rates, from principal and interest only to both also including interest only. But moreover, and I think that this will invariably be another question, is how we actually And to Lucia's point, given the unprecedented level of volume we've had, how we actually respond to customers of NAB in the first instance and make this the most seamless and frictionless possible process we can, recognising that for a lot of our customers, the timeframe needs differ. Some require immediate access to cash flow funding, whereas others we know will need that further down the track. But at this point, I certainly welcome any further questions you may have about any of the support that NAB is offering through the coronavirus pandemic. Thank you. Thanks, Lucia.
Thanks, Beck. I really appreciate that. And thank you to all our speakers today. But before we open up to questions, we just want to cover off concerns about wellbeing. That's obviously something that's really important to NAB, but also to many people in our community. You know, everyone is finding themselves under extreme pressure and mental strain, and it's something that, you know, not many of us have experienced before. So we just wanted to let you know that as customers of NAB, we are here to offer you free confidential support and coaching. We have a wellbeing provider that we use called Benestar Group, and how you engage with them is completely up to you. So you can use up to 3 hours of support via telephone or Skype, and it's at no charge to you. The details are there up on the screen, and as I said, we'll send this pack around with those details and links so that you can contact them directly. So please feel free to use that service for yourself or your staff where you need to. It's available to all of you. Well, now it's actually over to all of you. So as I said, we've had quite a few questions come through previously when everyone did the RSVP. So we will cover off some of those key themes that came through. Please use your Q&A function that you can hopefully see on your screen. And as I said, if you'd like to be identified, please let us know your name and we can address you when we're doing the questions. So Rowan, I'll kick it off to you. What's our first question for the afternoon?
Thanks, Lucia. And yeah, we had some great questions come through as part of the RSVP. The first one that we've got is on valuations. It came from Peter Gambrianis and a couple of others as well. Can you give our customers a sense of what NAB is doing, as there appears to be some concern on how valuers will be instructed and the variations that may come back?
Yeah, thanks, Rowan. NAB actually took a position on valuations quite early. It was becoming very clear when we were speaking to the various valuation firms that they were all looking to take a different approach, and that during this period of uncertainty, there wasn't clarity on how valuations would be performed. And when I'm speaking about this, I'm talking specifically about commercial security. So what we've done internally is worked with our risk team and with the regulator, and we've been able to put a deferral in place for valuations up until the 30th of September. So what that means for you is that if you've got a valuation coming due or one kind of imminently, that will be deferred. Your banker will then contact you in due course. We still will require valuation, but it won't be in this period of uncertainty. We're hoping that kind of helps customers at a time where we're not placing additional stress on you, and also so that valuers get a period of time. You know, based on what Alan said as well, there's so much uncertainty, to get a bit of a feel for how the market will land, so that we get that that right for you. So on the residential front, however, we are still continuing with valuations, and that's occurring for all residential security. And so far that's continuing. It's just for commercial security that we're doing that deferral.
Thanks, Lucia. While we're on valuations, I've got another one for you.
Yeah, no problem.
So if we have, what we do with valuations, say in the retail sector, hotels and or office do fall in the short to medium term, what are we going to do? Sorry. If they do fall in the short to medium term, once valuations are attained, what will NAB do?
No problems. That's something we're discussing internally at NAB at the moment. And, you know, until we know, as Alan mentioned, where these asset classes land, we won't know what the potential reduction in asset values will be. But, you know, we're there to support you should there be a fall. So we would need to look at every single customer's situation on a case-by-case basis. And we would need to potentially look at things like, for instance, if you're on interest only, potentially moving to a P&I, and that way you can build up additional equity in the particular asset. There's not going to be a one-size-fits-all approach here. We really need to see what happens when we come back. like, as I said, we've got the deferral in place for 6 months. Should things change, or, as Beck mentioned as well, we are changing consistently based on what's happening. If we need to extend that further, we will. So we've just got a period for review internally, and then we'll look at what happens from there and work with each of our customers on a case-by-case basis. So there's definitely no one-size-fits-all approach.
Thanks, LaChia. The next question we've got is for Alan, and it comes from James Fitzgerald. Alan, what are we seeing in the way of population growth forecast today in the next 12 to 24 months, particularly with respect to net overseas migration, births, deaths, and interstate migration?
Well, the short answer is international migration, I think, is not likely to be very significant for at least 12 months, because I don't see them closing the borders or reopening the borders anytime soon. And roughly, in terms of population growth, half of it is basically given, or in the past, has been from foreign people settling here. So you'd probably expect the population growth in the short term to halve, would be the bottom. I think in terms of what we're seeing in interstate migration, I don't think that's going to last long. So I don't think that's really going to have a big impact. But it is one of the issues that you look at the residential property market and you say, well, one of the things that's been keeping, say, Victoria up has been the strong growth of population. And so all those things feed into what you're likely to see. So it's going to affect tourism, it's going to affect education big time, and it's going to affect also commercial property because there's going to be less people essentially in buildings and more people doing what we're all doing today.
Thanks, Alan. Rebecca, the next question's for you from Josephina Virgo on NAB support. I think you talked a bit, actually, no, you've covered this one, didn't you, about the interest repayment deferral for the 6-month period and what's going to happen after the 6 months. Do you want to just quickly recap on that and then I'll go to the next one?
Yeah, I will recap on it. So perhaps just to provide some further clarity, we will do a check-in with all our customers at a 3-month mark that will help us to determine how they are tracking against the original requirement and whether the level of support that we've provided is sufficient to meet their ongoing needs. And that will also give us an indication of the potential support they're going to need at that 6-month expiry of the initial term. At that initial expiry term, currently there is an expectation that we will extend the term so that we can absorb the additional amount that would have ordinarily been paid back over that 6-month period, so that customers are not adversely impacted from a cash flow perspective, recognising that some may be in a position where they're not ready to reignite or restart repayments, and we'll need to work through them through that process.
Thanks, Rebecca. Next one might go to LaChia, and a number of customers have asked this question or have asked questions around the mandatory code of conduct for SME commercial leasing. Apologies, that was released by the government. Many customers aren't sure what their obligations are under the code to defer and waive rent for tenants. Are you able to clarify this for them?
Yeah, sure, no problems. So my first recommendation here would be to make sure that you've read the code. So it's on the government's website. Lots of accounting firms have also done summaries of this. 14 principles that are part of that code. At the moment, it's only been legislated in a few states. So WA and NT are the first off the bat, but it is being looked to be legislated in all states in Australia, or some variation to that end. So it's important also to note that it will be done retrospectively. So you will need to make sure you're up with the code and any negotiations that you're having with tenants at the moment to make sure it abides with how the code is based at the moment. In a nutshell though, effectively, the code talks to landlords providing rental relief to tenants that are affected by COVID-19, so when their turnover has reduced. And so it's probably easier for me to kind of demonstrate this by way of an example. So if you think about a tenant of yours that potentially had a rent obligation of say $10,000 a month, and they've had their business turnover has reduced by say 50%, the code kind of mandates that there'll be about a $5,000 reduction in the rent per month. And the way this is being handled is 50% of that is waived and 50% of that's deferred. So if you think about that $10,000 they're originally paying, there's a $5,000 reduction that's been mandated, $2,500 would be deferred and $2,500 would be waived. The portion that's deferred is a negotiation between the landlord and tenant around the period to pay back, but around that 24-month period or the term of the lease. Many customers are working through these negotiations, and I would say some customers are working with their accountants to get information from tenants around their reduction in turnover so that then they can appropriately start negotiations. So that's something for you to think about as well in terms of how you get the information to start that negotiation and that process. But that's effectively a snapshot of the key pieces of the code and how the rent relief works.
Thanks, Lucia.
I'll actually send a link to the code, in the materials that we send around.
Yeah. Following on also on the code, there was a bit of a sense of unease from some of the customers about how landlords were being treated by the code and the requirement to waive rents for tenants. What are the banks doing in this regard to support landlords who are caught in the situation?
Yeah, this is an interesting one. The code was released without direct consultation with the banks. And so to ensure there isn't negative ramifications as a direct result of this code, what we've been doing is been providing feedback to the ABA so that they understand the impact. And we've obviously had a lot of customers speak to us about this and the inequity in the code. So we have been providing, as NAB specifically, that feedback to the ABA and the industry at large. The code at present, by way of example, doesn't include a test for the size or profitability of the tenant. And this is something we've provided recommendations on. So I just thought I'd let you know that. As we've mentioned through Beck, we've gone through the packages of support that we have available for customers. It's probably key to kind of note as well, banks will also be negatively impacted because we will also need to increase provisioning for bad and doubtful debts. And this does also come at a cost of high capital requirements. So if we look to something like the GFC, unfortunately during that period of time, many businesses suffered and hence losses were increased. So we want to ensure that we're well capitalised to make sure that we can support you and all our customers in every industry during this difficult time fairly. So that's the reason why we've provided the packages the way we have in order to do that. Actually, I'll say one other thing, sorry, Rowan. One of the other things we are working on with through the ABA for government is land tax relief. That I'm not sure if that was asked as a question, but each of the different state governments are looking at that independently. So that will ease cash flows for landlords as well. So we are working with them on that too to help to support other cash flow needs.
Thanks, Lucia. The next question is to Rebecca, and it comes from one of our property developer customers. Rebecca, what support is available to property developers if they are no longer able to make any sales of apartments during this time and hence income is reduced significantly?
Yeah, so such a good question and so pertinent for this group. Effectively, cash flow and working capital is directly impacted, and that's where our NAB Business Support Loan looks to seek to offer that assistance. As I said before, whilst not used, the intent of that support loan is not for asset purchases or equipment purchases, but it is absolutely about how we ensure that the working capital requirements of customers are sustained and maintained through this period, particularly where there is fixed overhead costs that are unavoidable, through the intervening period. So that would be very applicable in this instance.
Thanks, Rebecca. Lucia, another one for you. Is NAB open to look at construction funding at this time?
Thanks, Rowan. The government is really keen to keep the building industry going, given it's such a large employer. And it's a testament to you, those on the call that are developer customers, just how quickly you've adapted to the social distancing requirements to enable work sites to continue and for your subbies to continue to operate under these restrictions. So as a bank, we are definitely here to continue to support our existing customers, and we'll review all new projects that you're looking into to commence. Obviously, similar things with normal development projects, regard to product type, quality, location of the development, and just having an understanding of that forward-looking view. It's interesting, Alan mentioned, the uncertainty in the next few months, but with a development, we're obviously looking out for a longer period of time for when practical completion will occur. So we need to look through the cycle to make some of those decisions. We're really keen, to support so that you can make sure you get all your ducks in a row so you can start your project. So as again, case by case, depending on the product type and location, but yes, we are here to support developer customers with projects.
Thanks, Lucia. Alan, the next one's for you. I'm not sure whether you can answer this one. I think someone's looking for some investment advice. They're looking for a comparison, if possible, of the outlook or commercial property versus publicly traded shares. And, are you in a position to comment on that one? And should I have my NAB trade open in the background?
No. Well, if I knew exactly what was going to happen, I wouldn't be working, is sort of the real answer. Look, I think the share market has sort of taken a bit of a hit, obviously. I think the share market is still probably overestimating the difficulty of recovery. They seem to be looking at the other side and saying it's coming out, don't worry about it. There are always, in the Spanish flu, there were 3 phases of the flu. And I think customers, or consumers generally and business generally are going to be cautious. They're not going to say, right, the world's now fixed and away we go. So I still think there's some downside in terms of the equity market. In terms of property markets, well, the equity market will adjust quicker. I think the property markets probably take a little bit longer. And I'm not sure what you should have in terms of your balanced portfolio, but I think you need to have it balanced, if I can put it that way. But all guys.
Thanks, Alan. We're now going to move to some of the questions that have come through to today, and we've got 24, so we're not going to be able to go through them all. So I'm just going to pick and choose a couple. Monica was one of the first ones to get in a question. I'm going to take her second question, which is I'm going to direct at Alan again. Even with the government's generous stimulus package in place, do you think unemployment will still reach 15%?
We don't think it's going to reach 15. The reason is that JobKeeper will help a lot. You're getting massive hits already. And I think 15 is probably, JobKeeper is going to keep you out of that. One thing that I didn't say that I probably should say is that once you get to the other side of the process, I think that the government's going to have to spend more money, because a lot of these sort of packages are set up for 6 months. And when you come out the other side, if they suddenly all disappear, that's going to be a problem. And also, if you look at inflation, I don't think there's going to be a lot of wage increases anytime soon, which means next year inflation is probably going to be pretty close to 0. And that means real interest rates actually have gone up, assuming cash rates stay where they are. Present inflation is about 1.5%, so there's a negative real rate of -1.25%. If inflation next year is 0.25 and the cash rate is 0.25, the real rate's 0. And so you need to spend more. Before someone says, oh no, but our debt will go up, I don't care. If I can get out of the economy quicker, in terms of a recession, that's money really well spent. And our situation, unlike Europe and US, etc., we're starting from a debt to GDP ratio of about 18. Now, maybe we'll get to 40, but even if we're at 40, the global average is 90 and they're all spending the same amount as us. So in a relative position, we're going to look pretty good. So I'm hoping that 15 doesn't happen. I'm pretty confident it's not going to happen. I think unless something really unexpected happens, somewhere between 10 and 12 is probably where we're going to end up. And we're going to unfortunately be there very soon.
Thanks for that, Alan. The next one is a question for Kane. Just a bit of a clarification from one of our customers. So, Kane, you were using an example where if a customer's rents are down by 60%, NAB would look at matching this by reducing interest costs. They just want to clarify, did they hear that correctly?
Yes, to a degree. I guess what the main point with that was saying, okay, if you've got a linear interest rate, let's say it's 1% over 5 years, it doesn't have to be the 1% over the full 5 years. So in the first year, say if there's rent reduction that the requests that you come in, it's going to be higher in the back end. The way to do that is almost like a seesaw. We can structure up, say, okay, you have a lower interest rate at 0.5 or 0.25 for the first period of time, and then increase the interest rate at the back end so that it's higher, but also matches those higher rental receipts you're expected to get. So I guess, and that's sort of the business relief package of deferring interest for 6 months' time while you've got no expense, no income, is matching off what those expenses are and interest expenses to when those cash flow timings actually occur. And I think that's the important point behind that. 60% was just an arbitrary figure, but everyone will have different percentages within their business. And the point behind it, though, is to make sure that you talk to your bank, you talk to your local markets dealer, and they explain what are the options around to try and get the timing of the cash flows right, not necessarily just what the net result is over the 5 years.
Great. I'll flick a quick question to Alan, or might be quick, might not. International students' education, huge part of the Australian economy. Are students coming back next year? And if not, has this been accounted for in your V-shaped recovery?
I think some of them will come back. I think a lot of them won't. It's going to depend on the price. I mean, if you can do your education from home, and you don't want to just get a visa in terms of end up with an Australian residency, then people are going to look around. And I'll use a very simple illustration. If I could get a degree from Melbourne Uni, or I could get a degree from Harvard and the same price, and it's the same sort of online learning, I know where I'd be going. And so I think that's one of the issues. And that's part of the reason why when, say, the governor of the central bank says, oh, we might fall 5%, but next year we'll grow even faster. I don't think that's going to happen. I think it's going to be sort of more equal, and some sectors difficult. And education, particularly the tertiary, that's big, and also secondary, and they're all the data we've got having really big hits at present. Thanks,
Alan. I'm just going to skip over a couple just in the interest of time, and I'm going to come back to valuations just because it seems like a hot topic. Sid has asked us, for existing clients with loan applications currently in progress, have NAB valuers been asked to ignore the current COVID-19 situation? Lucia, I presume you're best placed to answer this one.
Yeah, so for commercial security, so if we've got existing security in place and you've got a renewal or you've got an increase on an existing facility with existing security, we won't do an updated valuation at this point in stage. However, if you're structuring something up and it's a new facility and it's new security, we will still need to get a valuation for new security. Where we're unable to get a valuation in place, we'll need to look at rates notices and actually look at that and then provide some kind of bank value based on that rates notice. So it really is dependent. So I'll just kind of confirm that again. Existing security, no need to be revaluation done in this period, this 6 months period of time, that'll be deferred. If it's new security, NAB will require a valuation, and if we can't get a valuation, we'll use the rates notice to determine value.
Well, Lucia, we've still got some more questions, but I realise we've only got 5 minutes left. Maybe we might have to work out another way that we can cover off some of these remaining questions. Perhaps and of course there's always the avenue for bankers to speak to, so we might have to throw it back to you for a bit of a wrap for where to from here.
Yeah, no problems. Thank you for that. Well, I just want to thank everyone for all those questions. As Rowan said, we will come back to you with those key themes, with additional ones. I'm sorry, there's obviously a lot of questions with commercial real estate. We hope this webinar's helped you. And if we need to run more in the coming weeks, we will. So please give feedback to your banker where you feel like you need more information. If there's further things you would like us to go through, we're more than happy to kind of put these on again. We have been doing these by sector, so we have had them for professional services and health and government, education and community, so we can run more if you like. Poor Alan's been doing a bit of the roadshow, so he's well versed in all of this now, albeit different parts of the market that he's had to look at. So thank you, Alan. Thank you to Kane and to Rebecca as well. We will be issuing a survey after this, so we would love your feedback. So please let us know what you thought, ways we can improve. And as I said at the beginning, you know, this really is a crazy time for everybody. Please use the support available that we offer to you through NAB. It's available for you, as I said, at no cost. So we really encourage you to use that when you need it. And we are here for you during these times. So please reach out to Car if you need further information on anything we've discussed today. We want to thank you again for your time, and please take care and stay safe. So thank you very, very much.